Good morning. Welcome to Trading Hour. It's a tepid Thursday morning. I am Reema Tendulkar. With me is Vivek Iyer. The Nifty and the Sensex have now dipped into the red. They've lost close to about 100 points from the top of the trading session. We opened up in the green. The Nifty was closer to 25,280. So from that level, it's been a fall of about 105 points. It's the CPSE index which is under pressure. In fact, the Nifty CPSE index declines for the fourth day in a row. And this week itself, it's down close to about 3.5%. And not to forget the global context. Despite, Asian markets are still in the week. So after yesterday's fall, the Nikkei is down 1.2%. You've got a nearly 0.5% cut coming in on the Hang Seng and the Korean market. So there is no support coming from the Asian markets. The good part is the broader markets are holding up. So the mid-cap index is up nearly 0.5%. The small-cap index is outperforming. And look at that advanced decline ratio. Strong. Two stocks advancing for one stock declining, so firmly skewed in favor of the advancing on the gainer side. And a sector which continues to gain day after day is Pharma. The Nifty Healthcare 1 month chart will show you day after day. It's the Pharma index, low volatility, sort of a defensive play, and that sector continues to see buying. It's been a steady, mover, Pharma.
Well, you're absolutely right. Like you mentioned, it's the broader end of the markets that are doing quite well in the session. And on the back of that, yesterday we did see one trend emerge, which is that the oil marketing companies continued to gain on the back of falling crude oil prices. And even today, if you look at, some of the oil marketing companies, have a look at IOCL, HPCL, BPCL, all of them continue to see quite a bit of buying in the trading session today. Like you mentioned, pharma stocks doing very, very well. Look at, some of the mid-cap pharma names. So look at, the API players like Loris Labs, Ipca Labs. Also have a look at Mankind Pharma, Biocon, Alchem Labs. All of these stocks doing very well in the session. Other stock, on the downside that is seeing quite a bit of selling pressure is actually Minda. Over here, you actually saw a Kotak downgrade coming in. Kotak had gone ahead and downgraded this particular name, and Minda today is under pressure, almost 3% lower. Overall on par, and we are doing relatively better compared to the rest of Asia.
Indeed, like yesterday, right? Yesterday you had near 4% cuts on many of the benchmark indices. We got away pretty much unscathed. But let's talk about individual stocks. So Zomato catches your attention. It's a good 5% up move on Zomato. Here there's a JP Morgan note.
Well, that's right. So JP Morgan today has come out with a very interesting note. They've gone ahead, they've maintained their overweight stance on the stock. They've raised the target price to 340 rupees, from 208. So it's a significant target price upgrade that the company has come up with. What is the JP Morgan saying? They're saying that the company is spearheading a rapid retail consumer transformation via its convenience and selection-focused quick commerce business with very ambitious rollout plans. They're saying it's also going ahead, going deeper across all of the metros, having proven the model in the national capital region, where 50% of the gross value is something that the company actually gets out from. So what they're saying is that going ahead, Zomato should continue to gain from its scale, and it should also go ahead and help drive monetization from channel margins as well as ad spends. Along with that, they're saying that Blinkit also going forward will do very well. Overall, a very positive note, and Zomato today definitely one of the stocks of the day.
Indeed. Let's move on to talk about AU Small Finance Bank and Chola Invest. There is a brokerage note which is coming in from Goldman Sachs. So to talk more about it, Abhishek joins in. Abhishek.
Well, Goldman Sachs has initiated coverage on AU Small Finance Bank as well as, Chola Mandalam. So on AU Small Finance Bank, they have given a buy recommendation, target price of 831 per share. They say that it's ready for the next inning. Sector-leading EPS growth beckons this entity. So forecast EPS growth of 27% CAGR over FY24 to 27, wherein they will see an ROA improvement as per their estimate by about 14 basis points over the same period. So robust loan growth, which will be driven by commercial retail portfolio, which forms about 70% of the Q1 FY25 loans, despite a normalization in credit cycle. They say that AU Small Finance Bank is relatively better placed to peers, given the fact that there is improving deposit market share, better asset quality control, as well as operating efficiency, which has been gained out of the merger that they have done with Fincare Small Finance Bank. Coming on to Chola Investment, management, GS has initiated a buy recommendation and a target price of 1,786 per share on the entity. They say that market share gains amidst commercial retail upcycle is a key point that they notice in Chola, update over here. So they say that scaling up the non-vehicle financing business should help reduce the cyclicality in the earnings and improve visibility of the earnings growth along with the fact that there will be better return ratios for the company. So they expect Chola to deliver an EPS CAGR of 33% over FY24 to 27, wherein they estimate ROA to improve by 24 basis points in the same period, which will be driven by robust loan growth as well as market share gains that they see for Chola across products. Back to you.
Thank you so much for that, Abhishek. Both Chola Fin as well as AU Small Finance Bank are doing well in the session today. Well, there's a new kid on the block. It's actually the demerged arm of Raymond. Raymond Lifestyle has a good listing on D Street debut today, listing at 3,020 rupees a share versus the issue price of 1,563 rupees a share at which it was demerged. From the sidelines, we spoke to Gautam Singhania on what could be the growth drivers for the company going forward.
So the wedding season is strong. As we said, coming up for the next 6 to 9 months, we should have a very strong wedding season. So that should drive strong growth. Well, I think the Bangladesh opportunity is great. It's a good opportunity for us to take advantage of. And it's just playing out. So let's see how it goes.
Well, right now we need to cut across to the RBI Governor, Shaktikanta Das, who's addressing the FICCI IBA annual banking conference.
4% growth from a very feeble 4% growth in the second half of the previous year. That is 23-24 in the second half. Private consumption grew by 4%. First quarter of this year, private consumption has grown by 7.4%. This reconfirms the revival of rural demand. FMCG players, FMCG companies, if you talk to them, the data which comes out shows that clearly the rural demand is picking up and has picked up. The other important driver of growth, now apart from consumption, which accounts for 56% of the GDP, the other important driver of growth is investment, which accounts for 35% of GDP. Now, investment has grown at 7.5%, keeping with the recent momentum. So more than 90% of the GDP, that is private consumption 56% and 35% coming from investment. These are the drivers of the GDP calculation. Now more than 90% of the GDP expanded at a robust pace and materially above 7%. The headline number, however, came lower against the backdrop of muted government expenditure of both the center and the states, perhaps due to the elections. Excluding government consumption expenditure, GDP growth would have worked out or works out to 7.4%. Now, I don't want to get too much confined into these numbers, but I think it's when we talk that first quarter GDP has slowed down to 6.7%, we have to take note of that. We should not brush it aside. But at the same time, it is essential to analyze carefully actually from where where exactly the growth has slightly moderated, or which has actually, which has had a moderating influence on the growth, and to deal with that particular segment, while of course not losing focus of the other growth drivers. Now these are from the demand side, investment and consumption. From the supply side, while agriculture grew modestly at 2% in the first quarter, it is likely to perform better in the remaining months of the current year on the back of good progress of monsoon, good sowing of kharif crops, and good moisture conditions for the next rabi crop. Industry and services, which are also important components of the supply side factors which impact our growth. Industry and services recorded a growth of 7.4% and 7.7% respectively. Industry grew at 7.4%, services grew at 7.7% in the first quarter. Now they underscore the continued strength in economic activity. Construction activity, which is a very important segment of any growth assessment, construction activity remained robust, growing at 10.5%. Now, according to the Reserve Bank's latest data, bank credit to agriculture and allied activities remained robust and increased by 18.1% year-on-year. Credit to industry increased by 10.2% year-on-year in July this year, as compared to 4.6% in July 2023. Within industry, credit to MSMEs, and as you know, MSMEs are an important component of our economy. Within industry, credit to MSMEs also grew at 14.4% year-on-year. Bank credit to industries such as chemicals, chemical products, food processing, petroleum, coal products, and nuclear fuels and infrastructure has been quite strong till July 24. The enhanced credit flow to industry, along with an all-time high capacity utilization in the manufacturing sector capacity utilization is at 76%, which we gave out this number in the last MPC statement. Now, the enhanced credit flow to industry, along with an all-time high capacity utilization, points to an upturn in investment cycle as reflected in the NSO data. It is evident.
Okay, we'll keep coming back to important statements coming out from the RBI governor right now talking about India's growth. We'll slip into a very short break. We'll come back and talk commodities. Invite Manisha Gupta on the show.
Welcome back to Trading Hour. Well, one pocket of the market that's seen a bit of a comeback today is actually the FMCG pack, and within that, Titan today, now trading near the day's highest point, doing quite well in the session. But moving on, Apurva Sheth from Samco Securities joined us for a quick technical check on the market. Good morning, Apurva. Thank you so much for joining us. How do you see markets at current level, and where do you think is the next resistance as far as the Nifty is concerned?
So markets have been pretty weak in the month of September. In the last 10 years, 6 years have been negative for the markets in September. So, and apart from that, for the last 12 days that we have seen, markets have rallied non-stop, and on each day it has given positive returns. So whenever such things have happened, 1 month, 2 month and 3 month forward returns are also negative. So we expect that the current levels of 25,200 and 25,500, these are likely to be resistances, and markets can slip lower in the month of September, or chances are that we might not see very good returns for Nifty in the month of September at least.
How low could we go in September, Apurva?
So the resistance on the top is around 25,200 levels. On the bottom, the support would be placed around 25,000 and 24,500.
Okay, but not a meaningful correction then, even if we go down to levels of 24,500. So what about individual stocks? What are you recommending?
So today we have two stocks again. One is from the pharma space. Piramal Pharma has given a very strong breakout yesterday with volumes, and it was also up by more than 10%. So it shows that the momentum is shifting in the favor of bulls, and we are likely to go from third gear to fourth gear in the Piramal Pharma. So the target for Piramal Pharma would be 250 and stop loss would be 200. And another stock is JSW Holdings. We have seen recently that all the holding companies have been moving in tandem with each other, and even JSW Holdings was moving in a range of 1,000 points between 6,500 to 7,500. So currently it looks like the stock is breaking out, and if you look at from a fundamental perspective, the book value is around 22,915, and it's trading at 0.34 times its price to book multiple. So there's a lot of room for the stock to move on the upside. So the stop loss would be 7,000 and a target would be 10,000 levels in the short to medium term.
Thank Thank you very much for that. We will slip into a very short break on that note. On the other side, we'll talk about the discounts which are reigning on auto majors. The FADA numbers are out, and FADA has raised the alarm on the rising inventory levels. So just to get a check on what the demand outlook is ahead of the all-important festive season, we'll get a discussion going on the auto segment. Stay tuned.
Welcome back to Trading Hour. Well, now on to a CNBC-TV18 exclusive. Veranda Learning Solutions, a key player in India's edtech place, is gearing up for a major expansion. We have Rachna Dandrajani with us for more details. Rachna, what are your sources indicating?
Sources have revealed that Veranda Learning, the Chennai-based edtech company, is looking to raise over 1,000 crore rupees through a preferential issue. This move is expected to fuel its growth ambitions. We've also learned from our sources that Veranda is in talks to close a substantial acquisition. The company is in discussions with a privately owned, private equity-backed unlisted edtech company. And with this acquisition, it is looking to further strengthen its position in the edtech sector. Now, if we take a step back and look at Veranda as a company, it was founded in 2018 by the Kalapati AGS group that holds nearly 55% in the company. It then listed in 2022 and has grown on the back of major acquisitions. For instance, in just May of 2023, Veranda acquired 7 companies valued at 400 crore rupees. The company specializes in offering courses that prepare students for various competitive exams across India. And just last week, it forayed into the Middle Eastern market. For FY24, it reported sales of 362 crore rupees and trained a total of 6,93,000 students during the period. CNBC-TV18 has reached out to the company for a comment on the 1,000 crore rupees preferential issue and the subsequent acquisition, but it is yet to get a response.
Thank you very much for that update. Now let's, as promised, turn our attention to the auto sector. Now, the month of August has been tepid for automakers, particularly the passenger vehicles, the four-wheelers. Two-wheelers have fared relatively better. Now, the industry body, FADA, has also raised the alarm on rising inventory levels, which, according to some estimates, stand as high as 7.8 lakh vehicles and valued at 77,800 crore rupees. Over the last 24-48 hours, car makers like Maruti Suzuki and M&M have rolled out offers and discounts to drive up sales ahead of the festive season. So to talk about all this and more, we have with us Hormuz Sorabji, editor at Autocar India, joining in. Hormuz, thank you very much for joining in. This is Rima here. First, to your mind, how would you assess, characterize what's happening on the ground right now?
I mean, to be honest, it's quite natural actually, because you have to just rewind a couple of years and see, what happened post-COVID. You had obviously a huge pent-up demand, and in fact, that long tail of demand of COVID just about has gotten mopped up. You had a major supply crunch, semiconductor issue. So clearly, it was like there was just a huge supply constraint, and demand was outstripping that. Now there's no supply constraints. I think that pent-up demand has been completely absorbed, and frankly, it's back to business as usual. And don't forget, we are operating on a very high base. Last year, we had record sales over 4.2 million. Now, to expect a lot of growth from that, I think it's not sustainable. But I think overall volumes are still pretty decent. And if you go back to 2019 before COVID, I mean, you're seeing now the natural demand in the market kind of play out. And with that, you will see some offers. And obviously, before the festive season, it's nothing new to see in this time period where all the offers are rolled out. So I think, to me, it's just back to business as usual.
Hormuz, so right now you're not really worried about the rising inventory that we just mentioned as far as the system is concerned. Which segment of the market will you be more concerned over? In fact, Maruti, one of the largest PV makers, have actually said that they expect quite a bit of a moderation in demand. So, how are you looking, especially at the PV industry currently?
I think across the board, there's going to be a moderation. I think clearly what we've seen is that the lower end of the market still is firing.
Sorry to interrupt you, but the RBI Governor, Shaktikanta Das, is speaking again at the FICCI IBA Annual Banking Conference. We need to cut across.
As a regulator, we have done our best during successive global shocks which the Indian economy faced, along with so many other countries. And I must mention here that it was ultimately the joint effort, it was ultimately the cooperation between the Reserve Bank as a regulator and the major and the financial sector players like the banks, the NBFCs and other financial sector players. It is this active cooperation and it is this open door communication between us during these periods of successive shocks which has enabled our country to be where it is today in terms of financial stability. So the financial sector has repeatedly demonstrated its ability to overcome the challenges and the successive shocks from various global factors. The financial sector showed remarkable resilience during the COVID and also in the aftermath of the COVID-19 pandemic. Today, all key indicators of the financial sector demonstrate robust health. This resilience combined with other forces can act as critical driving forces for India's future. In this milieu, financial sector needs to even further deepen financial inclusion, broaden access to credit and other financial products, and support overall inclusive growth. It also needs to drive innovation in digital banking, foster sustainable finance, and build robust financial ecosystem that can withstand emerging challenges and facilitate higher trajectory of growth. With the financial sector now in a strong position, it is our collective responsibility to safeguard this stability, especially in an environment of heightened global uncertainty. Financial institutions must continuously assess and refine their business models, recognize and deal with emerging risks, and remain focused on capitalizing on every new opportunity. This brings me to the important issue of inclusive growth. But before going into inclusive growth, I think it's a point which has already been touched upon by the previous speakers and by also the presentation that was made here. I think a key focus area, and I'm not saying anything new or which is not known, but I feel it is necessary to constantly, keep reminding ourselves that these should be our priority focus areas. I think we have to be also mindful of several non-financial risks. The financial sector, the financial parameters of the financial sector today are strong and robust, but we also should be mindful of the potential, the sources of, what you call non-financial risks, which may affect the financial sector. And in this, I would like to include elements like cybersecurity, managing third-party risks, managing spillovers from a rapidly changing global environment, managing and adopting new technology into our operations, into our business practices, and several such initiatives. At the Reserve Bank of India, we have been embracing technology, and we are trying to keep up ourselves with regard to utilizing technology, with regard to utilizing AI in our internal operations, whether it is supervision or in other areas. UPI is a great example about which the whole country can be proud of. As you are aware, central bank digital currency, that is CBDC, e-rupee, we are one of the, we are among the very few countries which are running pilots. I would also like to mention, we have already announced in public domain, that we are setting up a cloud facility for storage of financial sector data of all financial sector players. And this is something which will be of particular benefit to the smaller entities in the financial sector, whether they are small NBFCs or they are medium-sized NBFCs or small private banks, or for that matter, the urban cooperative banks.
Okay, we'll keep coming back to that, but we were in conversation with Hormus of Autocar. Thank you very much, for waiting on patiently. You were telling us about the passenger vehicles and the kind of discounts that we've seen from the likes of Maruti.
Yeah, so I think, this is actually quite normal. One has to remember that a lot of the manufacturers took advantage of the huge supply constraint, as well as the huge kind of, boom in demand after COVID. Two things which really kind of led to, this huge supply constraint. And I think let's go back a few years again and remember that earlier it was getting an early delivery was the new discount. At that time, people were happy to pay the full price. They just wanted the car as soon as they could get it. There were waiting periods of over a year on popular models. So I think that's all changed right now. And clearly, we've come back to a very natural kind of, let's say, environment in the market. Also, what manufacturers did, a lot of them, including Mahindra, raised prices well beyond what they had launched. That just to take advantage of really the demand that there was and the supply constraint. Now that's all kind of balancing out, and clearly you are getting the offers to keep that demand and the volumes going. I'm not too worried about the volumes, honestly. They will be flat, but again, it's a very high base. Don't forget, a lot of manufacturers have added capacity, so they do need those numbers. But I think as we go into the festive period, I think, we'll see with these offers demand picking up.
Harmal, now coming to the two-wheeler space, what we want to ask you is, number one, there's quite a lot of intense competition as far as this particular space is concerned. But some of the incumbents, actually, if you look at TVS, Hero, as well as Bajaj Auto, they've actually done very well in terms of sales, at least in the last 3 months. So number one, how are you looking at the incumbents? And also, what is your view on Eicher Motors? They seem to be slipping in terms of market share. And are all of them going to cede market share to Ola?
Well, I think, clearly, I think the two-wheeler market is coming back. It shows, that there's kind of a rebound at the lower end of the pyramid. And I think I've always believed that, everything that the legacy players know this business better than, the new players, because clearly it's a very oily business. It's a very nuanced business. It's very, very granular. And, I think it's not easy to kind of break into this. Of course, Ola has disrupted the market. But frankly, I think, there's a lot of smoke and mirrors around what they're doing. I think, for me, right now, just one product, and that to a product which has really been kind of, let's say, rebadged or imported. They're buying market share right now. We've seen that profitability is nowhere in sight. So frankly, I don't see them as being a long-term threat at all. And I think that's where the legacy players will fight back. I think on the EV space, clearly, they are in a wait and watch mode. They could definitely pump out more EVs, be it Bajaj or TVS. But clearly, there's no margin on that. And really, the margin comes from their ICE products. So I think, looking at the two-wheeler space, I am just bullish on the legacy players, kind of really ruling the roost there for a while.
Okay, well put,
Talking on Eicher, I think Eicher really, Enfield, I think you will see new products coming out from, RE. And clearly, I think, from in that sense, obviously there will be slippage, but, it's very cyclical as well. I think there's a whole raft of products coming out, and I'm sure, it's such a strong brand. In fact, it's a brand that goes beyond the product. I think, they have a bounce back at some point.
Okay, so Ola's buying market share and not a threat to the incumbent players. So I've got 2 quick questions and we've got 1.5 minutes. I'm going to squeeze them in. One, what about the discounts on the luxury cars like BMW, Mercedes, etc.? Because those prices have ballooned, post-COVID. And secondly, what would be the top 2 or 3 exciting launches one should watch over the next 3-4 months?
Well, I think, looking at I think looking at the luxury end, I mean, now, a crore seems to be quite normal for a luxury car. In fact, the growth has been in that segment, what Mercedes calls the top end luxury vehicles, which is a crore plus. Very, very small base, but a lot of growth over there. Frankly, I don't see, I think that's one market which has been resilient because if people have money, they'll buy it. They're not too bothered about, whether it's what discounts they get over there. But I think lower down in the, let's say the mainstream luxury market, of course, discounts are rampant again. And again, prices have actually just gone through the roof. I think the other thing what we've not realized is that for whatever reason, there could be regulation, emission, raw material. Prices have just gone up and up and up. So I think we are just seeing a natural correction of what the values of these products, even at the luxury end, should be. But I think, it's more in the mass market that we are going to see a little bit more correction, as far as pricing goes.
And the launches?
Yeah,
Two or
launches,
three
I think.
exciting ones, yeah.
I think the big one for me is going to be the Thar Rocks, which is, I think, really going to knock it out of the park. Looking at the kind of response that has been at the dealerships, I would even say I wouldn't be surprised if it comes. They get close to 2 lakh bookings. It's just a guess because they're really it struck a chord, and it's just this combination of cars becoming a little bit more emotive, especially after COVID. People have fallen in love with cars again, and I think this is a reflection of that. I think what will also be interesting is the new Alcazar, which Hyundai are launching. It's a facelift as well, but again, for Hyundai, it's very important that they kind of get success in now whatever models that they have looking at the IPO. I think the Tata Curve EV is very interesting because the EV, the Curve EV, looking at its pricing, the response to that is going to be very critical because that will determine the response to EVs in general. So if the Curve EV doesn't fly, that's not good for the overall EV market because it's super well priced. It's very well equipped, got a lot of range, and Tata has thrown everything it possibly can into the Curve EV. So yeah, we've got to just see, how that does. So I think these are really the 3 big launches this year.
Right. Thank you so much, Hormas, for joining us and giving us a lowdown as what exactly is happening as far as the auto space is concerned. Let's now take a short break. Up next, we'll discuss market fundamentals with Jyotivardhan Jayapuria of Valentis Advisors. Welcome back to Trading Hour. As promised, we have Jyotivardhan Jayapuria from Valentis Advisors to discuss market fundamentals and its top sectoral picks. Thank you so much for joining us, Jyotivardhan. First up, how are you? What are you making of the market currently? We are at elevated valuations, but there doesn't seem to be anything that is stopping this particular rally. What worries you at this point of time?
Yeah, so like you rightly said, the valuations are not cheap. And historically, from these sort of valuation, returns over the next 1 year have not been very high. It's not like they've been negative, but they're probably single digit sort of returns which are there. So at this time, it's always in the market, it is what is the margin for error. The margin for error is quite low. The margin for safety is low at the moment. But things are still looking decent. The economy is doing fairly well. I think more important is that the macro fundamentals are good. Like if we think of the fiscal deficit, we think of the current account deficit, all those things are under check. So that is, one of the biggest positives in the market today.
Pharma is a space that you've been bullish on. Is this a recent addition that you've started accumulating more and more of pharma? And in pharma, what is it that you like?
No, so Reema, pharma is something which we've been adding for the last, I would say, 14, 15 months. And the change we made was earlier we were quite positive on the domestic pharma, but like 15 months ago, we turned positive on the US generics. And that's why we made a lot of the additions. All the companies get to US generics. If you see for the last 5-6 years, the US generic prices were continuously falling. And so what we were having a situation is that part of the business was bleeding for everybody. So our call was that the US generics have bottomed out. Prices will fall at a very slow pace or they'll probably remain flat. And the demand continues to be good. So we were buying more and more companies which were geared to the US generic business. And that's why we have done a lot of additions. The other thing which we've held for a long time and we continue to hold is the whole CDMO space. So that I think is a very interesting space, will do very well. We own a couple of small companies in the CDMO space, which I think will have multiple years of growth. So, if you just think of next 5 years, 7 years, can they grow earnings at 25% sort of range? Yeah, it's possible. And that is the other space we have in pharma.
Jyotivardhan, you spoke about the pharma pack and especially within that you spoke about the CDMO space. How much of a trigger do you think is, the likely imposition of the US Biosecure Act going to be as far as the entire value chain is concerned? And when you speak about, generic pricing, halting, where do you expect it to stabilize?
I would say generic prices probably are not going to go up much, but they're probably going to be flattish around these levels. But what you've seen is a very continuous price drop over there for the last 5-6 years. So, a lot of the price drop happened because there was a consolidation of the chain in the US. And that led to, squeezing of the prices because the buyers became bigger. But I think that is more or less done. And now we'll probably see a bit of, stabilization of prices because demand is fairly robust. Now, the biospecular will be good for India. So it will be good for the CDMO players and it will help, move things to India from China. So on the margin, again, that's one more addition to the positive for the pharma space.
So would you still buy pharma right now, the US generics or any of the CDMO players? Because you just said, the generic prices have stabilized after the recovery. So is there still upside?
So there's still upside, Rima. There'll not be as big like, when we bought it, like it's seen huge upside after that. But from here, we'll get a steady 15% sort of returns in them, probably even 20% sort of returns. The CDMO space is something which I think is good. Like I said, it's something where, very secularly you could see like 20 to 25% sort of earning growth in many of these companies. So they'll be much bigger than where they are today in the next 5 years. It is a volatile sector. It doesn't lend itself to like quarterly numbers because there are some quarters where it can be very awful. But what you have to do is just stay the course. And for the next like 3 years, 5 years, we know that these companies will be much bigger than what they are today.
Jyotivasan, I just want to squeeze in one last question. What is your view currently on the financials as well as capital goods, especially capital goods has done very well, if you're looking at it from the last 3 year point of view?
So, we were very early into capital goods because we had this whole theme that we like investment theme rather than consumption theme. On the margin, we actually selling some of our capital good names, largely because of the valuation. So the stocks have done very, very well. And we have this whole, free use philosophy. So they're no longer undervalued. They're no longer underperforming. And now, they're reasonably owned also. So on the margin, we are selling. We're not sold everything because we still think there's a lot of earnings growth going over there, which we do. We are actually putting some incremental money in the banking space because that space is totally ignored just now. It's like, done very badly. And things there are, it's one of the few spaces which are where there's value. Most of the stocks now are trading at very high valuations and you have to bank on growth coming to generate stock price returns. But bank is one space where there's actual value and, there's 2-3 quarters of pain in terms of the NIMs. But I think given the valuations we can make decent money in the bank names from this level.
Jyoti, short conversation, but a good one. Thank you very much for joining in. We need to slip into a very short break. On the other side, we'll focus on Nykaa and we'll invite Karan Taurani of Elara Capital. Stay tuned. Welcome back. So yesterday, Nykaa held its beauty summit. It's a highly anticipated event, and there were lots of interesting takeaways. They spoke about how the beauty segment is one of the fastest growing segments. The market size is anticipated to hit $34 billion over the next couple of years. Men's is a growing category. So to talk more about it and what are the implications for Nykaa, Karan Taurani of Elara Capital is now with us. Karan, lots of interesting takeaways. L'Oreal's India MD also said that how the next 2 decades are the most exciting time for India's beauty industry. What would your key takeaways be from what we heard yesterday?
Hi, Rima. Morning. So I think it's a clear indication that beauty market is expected to grow at a fast pace. And I think within that, I think online will grow at much ahead of the overall growth rates. Overall online BPC growth rates could be about 20 to 25%. Nykaa being a market leader will see a very big advantage out of this. I think, the threat of quick commerce is now kind of overdone because, companies like Nykaa have got a very strong presence in the non-metro markets where quick commerce is not present for now. I think even in terms of competitive intensity, we haven't seen other platforms really scale up in the BPC segment, which is why, Nykaa will probably have the clout here. I think in terms of categories, hair care, skincare are the 2 good categories. Large, can potentially become very big with, very hefty growth rates. A lot of product innovation is happening in these categories as well. So net-net, I think it looks like a very strong growth market, with lower competitive intensity, and players like Nykaa will continue to have a clout because of the premiumization and the trustworthiness factor.
Karan, you are expecting Nykaa to see a steady state revenue growth in the range of 30 to 32%. Now, do you think that can continue? What will aid that particular revenue growth? And do you see margins sustaining or maybe even improving from the current levels, given the fact that you mentioned competitive intensity is reducing?
So I think in terms of growth, the core BPC segment growth rates remain to be about 22 to 24% as per our assessment. They have kind of merged the B2B and the MAN segment. That's why the growth rates right now for the BPC segment are more towards 30% plus. But there are no changes in terms of core BPC growth rate. I think that will continue more led by customer additions and more led by frequency. I think AOV is largely capped as far as Nykaa BPC is concerned. So that's the first thing. Second thing, on the margin front, I think it's very clear that there are multiple levers for margin expansion as well. One is, the discounts have now kind of come off. We saw this entire thread from quick commerce over the last 4 to 5 quarters because of this discounting had increased on Nykaa. So I think that's largely done with. It's kind of plateaued. I don't see any kind of lower take rates from here on. So there's no margin pressure basis that. Other two levers are basically on ad revenue. So we have seen a comeback in terms of ad revenue in Q1. And hopefully, if this potential continues, we'll see better margins basis that as well. And there is also lower losses from the fashion and the other business, which could actually lead to a better margin for the overall BPC business. So the point is that I think we are assuming a margin expansion of anywhere between 200 to 250 bips over the next 2 to 3 years. And if that plays out, you could see, earnings grow or rather EBITDA CAGR of anywhere close to 35 to 40%.
What about Nykaa Mans? Where does it stand at currently in terms of a size, and what is the potential?
So Nykaa Man, the numbers are exactly not known, but they club this entire B2B and Nykaa Man segment, which is potentially about very small in terms of size. It is about sub 10% as on today. The core business remains to be BPC, but clearly expansion into multiple categories, focusing on private labels, going T2C, focusing on the hair care, skincare, fragrance kind of categories, going global, going omni-channel. These are all potential growth drivers for Nykaa. And I think if they're able to kind of execute on margin, you will see upgrades as far as numbers are concerned.
You spoke about 200 to 250 basis points of margin expansion from here on, and there are multiple levers to that. So this Nykaa Man and B2B are not expected to be big growth drivers, and also elaborate a little bit more on Nykaa Fashion and the kind of losses they currently have and how it's expected to be. You spoke about it coming down.
So firstly, Nykaa Man and B2B are expected to be big growth drivers, but they're coming at a small base. In terms of overall contribution, they are sub 10%, so there's not a big impact basis their strong growth. But yes, growth potential in those segments are about 60 to 70% or even more than that on a CAGR basis. So that's the first thing. And losses have to converge in these segments. So the B2B segment is currently making losses, and that is negatively impacting the BPC business EBITDA. So if the losses converge, you could see margin expansion beyond 200 bips, as per our assessment. As far as fashion is concerned, the growth therein has been very volatile. We have seen times where the business has grown 35-40%. We've seen times where the business has grown 20-25%. So I think a sustainable growth with 25-30% kind of a number with increase in market share and with reduction in losses is a key monitorable here. Because if you look at the fashion business, the overall contribution to valuation is more than about 7 to 10%. Because clearly the margins are, they've not made margins. They've always made losses in the business, but they have guided for a break-even point over the next 2 years. And if that were to happen, then you could see rating in the fashion business as well. So maybe this 10% contribution moves up to 15 to 18%, and that could also drive further upside. So there are incremental triggers which can play out, but that all depends in terms of execution.
Thank you so much, Karan. Short but very interesting insight as far as Nykaa is concerned. Time now for a quick break. We'll get you more on the market on the other side. Well, welcome back to Trading Hour. As you can see on the top of your screen, it's the broader end of the markets that are doing much better compared to the benchmark indices. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime report is up next.